So now that you guys have thought about a specific growth investment for your business, let's walk through a couple of examples and understand the economics and how to model out that investment opportunity in practice. So let's assume that you're an individual designer running your own agency and you're thinking about bringing on an additional employee. Let's walk through how to think about that additional cost and what the return on that investment might look like, and whether a loan might be the right tool to help you accomplish that sort of growth. So you're an individual designer, you're currently breaking even in your business, and you want to bring on an additional employee. Let's assume that that additional employee salary is going to be $80,000. Now, you know that salary alone isn't the total cost of bringing on that new employee. You also have to pay for healthcare and payroll tax and maybe new equipment for that person. So the additional expenses with regards to that new hire are $20,000. So this is salary. This is additional expenses. So the total cost of bringing on that new employee in a given year is going to be $100,000. So you're looking to borrow $100,000 to essentially cover the total cost of the loan. So let's assume that equals total loan amount. And let's assume that that lender approves the loan and it's going to cost you 10% in interest. You're paying that loan over the course of 1 year. So keep in mind, if you borrow $100,000, you're paying back a percentage of that amount, let's say every 2 weeks or every month throughout that year. So interest is only going to accrue on the amount of principal remaining at any given time. So it's not the total cost of the loan isn't simply going to be, $110,000. It's going to be slightly less. So let's assume that it's $105,200. Another really important thing to think about, obviously, the whole point of bringing on a new employee is that you believe that they're going to help you generate more revenue. So given what you're able to produce today, you assume that that new hire is going to be able to generate a similar amount of new clients and new additional revenue. So let's assume that that's $250,000 in revenue to the business that new hire can generate. You have $100,000 in expenses. So $150,000 in profit. And the true cost of the loan is about $105,000. And one important ratio that every lender tries to measure is the ratio of profit to the true cost of the loan. And most lenders have a minimum, what they call debt service coverage ratio of 1.15. And so long as this ratio of $150,000 over $105,000 is greater than 1.15, you're likely to get approved. So the actual ratio of this is about 1.4, which means you're in the green, and this loan is likely to get approved. Awesome. Let's try a different example now. You're an existing production studio that's been in business for a few years, and you're already generating revenue and profit. So you're currently generating, let's say, $100,000 in profit per year. So things are going really well, but you want to invest in new production equipment because you believe that's going to help you land higher quality clients and generate more revenue for your business. So let's think through the return on that investment and whether a loan is the right tool to help accomplish that growth opportunity. So you want to buy, let's say, a handful of Red cameras. You want to buy, new Apple computers, potentially some lighting. It's not going to be cheap. It's going to cost you $150,000. So the amount of capital you're going to look to apply for is $150,000 equals loan amount. Now, we already talked about your business generating revenue. So let's look at what paying back that loan over a 2-year period might look like, because you believe that you're going to generate enough revenue over 2 years to be able to pay back that loan. And because we already talked about your business generating revenue in both year 1 and year 2, it's already generating profit, right? It's $100,000 in existing profit with your current team, current equipment today. an important thing to ask yourself is how much additional revenue is this new equipment going to let me generate, right? I'm going to be able to take on new hires, new clients, bigger projects, more revenue. So not all of that's going to come immediately, right? It's going to take me time to market this new equipment that I have. So I'm going to generate, let's say, $50,000 in additional revenue in year one. And because in year two, everybody's going to know that I have these awesome new cameras, I'm going to make $100,000 in year two. Now, I also know that it's going to cost me some money to maintain this equipment, or I may need to hire some contractors to come in whenever we're doing these shoots to man the lighting and man the cameras. So that's going to cost me roughly $40,000 a year in additional expenses. So this is new revenue, and this is expenses. Now, when I applied for $150,000, the lender is going to look at my existing profitability, the owner's personal FICO scores, the business credit history, the cash flow of my company to generate what they believe is the right risk and interest rate associated for that loan. So to keep things simple, let's assume that it's a 10% interest rate. The true cost of the loan is going to be about $165,000. Now, it's important to understand how much profit am I going to generate by bringing on that additional equipment and this additional expense. So we already make $100,000 a year in profit. We have $50,000 in the first year in new revenue, $100,000 in the second, and $40,000 in expenses, right? So I have $150,000 in gross minus $40,000 in expenses. I'm going to make $110,000 in net profit in year one. And I'm making more in year two, so it's $200,000 minus $40,000 is $160,000 in year two. And because I'm not paying off this total amount immediately, we can divide the true cost of the loan in two. So let's assume that it's $82,500 in year one, $82,500 in year two. And so as we talked about in the last example, the key ratio that most lenders are looking for is what is the relationship between profit and the total cost of the loan on an annual basis. And most lenders are looking for a minimum, what they call debt service coverage, of at least 1.15. So if I look at just the ratio of these, in the first year it's 1.33, and in the second year we're doing much better, so it's 1.93. And most lenders will take the average of those two numbers, and let's say it's just around 1.6 for debt service coverage. And because 1.6 is greater than 1.15, we have very good likelihood of this loan being approved.